It's time now for a look at the day's top business news with Brian Quinn. Hi, Brian.
Hey, Karis.
You're starting with those devastating wildfires that continue to ravage Los Angeles. They could end up being the most costly in U.S. history.
So, of course, on top of the 24 lives already lost, there will be this massive economic fallout, not just from the initial property destruction, but from the disruption of industries like the entertainment and tourism industries, lost wages, the cost of relocating and rehousing many thousands of people. U.S. Weather Service AccuWeather has already tripled its initial estimate of how much these fires are going to cost, now projecting the total damages at between $135 and $150 billion. That is roughly 4% of the entire annual California economy. Previous natural disasters have had even worse economic impacts. Last year's Hurricane Helene, for example, is estimated to have cost some $250 billion. But LA's current fires are far beyond the impact of 2023's fires on Maui, currently on par with the full 2020 fire season for the entire United States. The main reason for that is, of course, the location. Here's AccuWeather's chief meteorologist on why.
What was so different about this is that it occurred in a densely populated area with some of the most expensive real estate in the entire country. That's why this disaster is clearly going to become California's most costly wildfire in modern times and may become one of, if not the top, most disastrous wildfire, damaging and costly wildfire in U.S. modern history.
Well, the scope of the disaster is once again shining a light on mounting difficulties for the U.S. insurance market.
So we've seen this phenomena across the U.S. amid these increasingly frequent natural disasters linked to climate change, with many worried that parts of the country will become essentially uninsurable. Estimates for insured losses for these fires are already above $20 billion. But many homeowners across California have actually lost their policies as companies are less and less willing to take on risk. From 2020 to 2022, insurance firms declined to renew 2.8 million policies across the state, more than 500,000 of those in LA County. The California state government does have a backup system for insuring homes called FAIR, which has seen demand skyrocket. As of September, its residential exposure was at nearly $460 billion. That's up 61% from just a year earlier. New regulations in the state are expected to force private insurers to issue coverage to homeowners, but those insurers will now be allowed to pass on the costs of their own reinsurance policies, which could send rates for homeowners up by 50%. Consumer advocates say more reform of the insurance market is needed. Take a listen here.
We need new protections in place to prevent insurance companies from abandoning consumers who do the right thing and harden their homes, meet state wildfire guidelines for brush clearance and home protection. That way, we can make sure that Californians who do the right thing can maintain their coverage. We create an incentive for other consumers to do that in the future, and we stabilize the home insurance market.
Okay, let's check in on the day's trading action. Break it down for us, Brian.
Well, Asian indexes, Karis, mostly losing ground in Monday trade after the latest U.S. jobs report came in stronger than expected, that dimming hopes for new interest rate cuts from the Federal Reserve. Tokyo's exchanges closed on Monday. Hong Kong and Seoul, though, each down more than 1%. Shanghai is faring a little better after the latest economic data out of China. It shows the country's trade surplus hitting a record of nearly $1 trillion last year. New tariffs under the incoming Trump administration, though, are expected to put a damper on those exports. Crude oil prices, meanwhile, are at their highest in months after the U.S. unveiled new sanctions on Russia's oil and gas industry. Those sanctions likely to severely limit exports to China and India in particular. Brent crude and WTI each up nearly 2% there.
And we wrap up business in Bangladesh, where the textile industry is returning to growth after a student-led revolution last year toppled the government.
So Bangladesh's long-suffering garment workers were often on the front lines of that revolution. Even after longtime autocrat Sheikh Hasina was ousted, though, they continued protesting for higher wages and better working conditions. They did eventually win a 5% wage hike, but many now say that despite an industry rebound, their lot has not improved. Tolano D'Souza reports.
In this Bangladeshi textile factory, employees are hard at work sewing outdoor gear for major Western brands. Some 22,000 people are employed by the firm, which is operating near capacity.
At present, we're quite busy. We expect 30 to 40% growth in 2025 compared to 2024. We're almost fully booked for the next 7 to 8 months.
Bangladesh is the world's #2 nation for garment production. The industry makes up 80% of its exports. Last summer, it was severely disrupted when a protest movement against government hiring practices exploded into a revolution, with garment workers often on the front lines. Autocratic leader Sheikh Hasina was ousted, replaced by Nobel laureate Muhammad Yunus. Still, garment workers kept up their protests for higher wages and better conditions. Dozens of factories closed, tens of thousands lost their jobs as exports fell by some $2 billion annually. In September, workers won a 5% wage hike and returned to their posts. Since then, the industry has rebounded, growing 13% in the second half of last year. Workers, though, say their situation has not improved. The meager raise has come with massive hikes in production targets.
International buyers are only concerned with their profits. They don't want to pay enough so that the factory owners can give workers a living wage.
Meanwhile, many of those laid off during the revolution remain unemployed. Those with jobs remain underpaid, and Western brands continue to profit.